I'll just read the top quote for those of you who can't see her. Higher borrowing costs have pummeled the commercial real estate industry, driving prices lower and causing some owners to choose to default. Much of the potential distress is tied to buildings that need a refinancing at a time when lenders are tightening credit following the collapse of several regional banks. The second quote just talks about regulatory scrutiny. So in this age of tightening credit, one of the reasons is because the regulators are all over the lenders. And the lenders are just uptight about putting out money with the risk of a lender criticizing and categorizing those loans. You've got this bid-ask spread where sellers still think their properties are worth what they were worth, and buyers say, no, we're not paying those prices. And that's holding up transactions. What does transact are the properties that kind of have to transact because the seller has to sell, because maybe the debt's maturing, they can't refinance, maybe there's a drop of equity, maybe it's going to be a short sale, it's not going to cover all of the debt, but the banks have agreed to a short sale. And those are what's transacting. So what that ends up doing is creating this like vicious cycle that the property that does transact, take that early example from page 1 about the Sheridan, which was purchased for 700-something million years ago, now sold for 300-something million. Well, think of what happens on an appraisal when the appraiser goes out to appraise the next hotel. Room values just chopped in half. So the comparable sales that are being used in appraisals are just going down. And when you go out to refinance and you get an appraisal, it doesn't look good. Even if nothing has changed with your property. So you kind of get that vicious feedback loop.